Hi there YouTube, it is Monday the 16th of October, and that means it's time to take a look at what moved the markets last week. Starting with the two biggest stock indices in the US. On top I have the NASDAQ 100. It's not very clear because of the way the dates align, but from Friday, 2 weeks ago until Friday last, the index didn't move that much in the end, but the fact that it closed more or less where it opened over that 7-day period hides the fact that we saw quite a chunk of volatility through last week, and we'll talk about why during this video. The same more or less applies for the S&P 500, which is the index on the bottom. However, this was slightly less volatile, which is usually the case. The NASDAQ 100 is full of tech companies that tend to be more volatile. In terms of the notable macro data that I follow, last week we only had 2 days of high impact macro data, but it was very important data. So in Germany, the CPI number came on bang on. The PPI number in the US, quite worryingly, came in at 0.5%. It was forecast to come in at 0.3%. The PPI number is the leading version of the CPI number, both of them being inflation indicators. And PPI gives us some insight into the rise in costs that will be passed along to consumers in future periods. That's because this is inflation as it applies to the people that make things in the economy. And so the costs that they're paying, the higher costs in this case that they're paying, will only be passed along once the consumers are able to buy the things that those people are selling. We also got some insight into the meeting notes out of the last Federal Reserve meeting. I'll talk about that in a moment. UK GDP came in bang on. And very interestingly, the CPI numbers out of the US, especially this year-on-year and month-on-month number, were slightly higher than expected, which is something that we do need to take note of and is worth digging into. When I mean digging into, so CPI or any of these macro indicators are headline numbers that have a lot of detail beneath the surface. So you can break down the CPI number into a number of subcategories, and going through them will take a lot of time and also probably be quite boring unless you are a numbers nerd. So the Financial Times does a good job of breaking down this data and usually presenting it quite visually. This data is from the US government. We can see that core inflation, so that's inflation minus the things that are considered to be more volatile, continues to drop, which is good because core inflation can be quite sticky. And in fact, that has been the stickiest component of inflation through the past few periods. We can also see that a few months ago, inflation overall seemed to bottom at about 3% and has rebounded slightly since then. If we break it down one level further, we can see that some of the things that have been big concerns at the bottom, you've got utility gas, services, airline fares, used cars and trucks. These were some of the heaviest components contributing to the rise in inflation initially, are now in negative territory. But we are also seeing other service-related prices that are very, very high. So motor vehicle insurance has gone up quite a lot, and this is the case in the UK too. For anyone that owns a car in the UK, you will know this already. But the prices in a lot of these components that are contributing a lot to inflation can come down quite quickly, except for shelter. So the cost of shelter tends to be incredibly sticky, rents typically being the largest component of shelter, and so this is quite worrying. We did get a bit of a surprise. The Fed officials seem to be a lot more dovish than everyone has been expecting. It was almost a certainty that another rate hike was on the cards this month. But with the yields on interest rates continuing to stay as high as they are, the opinion is that the Fed may not feel as though they need to hike the interest rate because the bond market has done its job for it. For those that want to understand this in a bit more detail, if the yields on bonds are rising through the US, then the interest rate in effect has gone up and the cost of borrowing money has become more expensive. This doesn't guarantee that the Fed will not take action and we won't see another interest rate hike through this year, but the chances of that happening seem to have come down somewhat. One of the other things that happened last week was that the large US banks started to report earnings. JP being the first of these banks. The company absolutely obliterated earnings expectations. Their estimated EPS was $3.95, but the EPS actually came in at $4.33. You can see from this table that their year-on-year change for their earnings has been 38%, an enormous increase in profitability, especially in the current conditions. But the rise in interest rates has been favorable to banks, depending on the kind of bank they are. consumer-facing banks might have performed differently from investment banks, which might have performed differently from those banks that typically deal in mergers and acquisitions. At the same time, we heard from JP Morgan's leader, old Jamie. He does love to get on his soapbox from time to time, and he said the world may be facing the most dangerous time in decades. I would take this with a pinch of salt because he has a bit of a flair for the dramatic. Whilst there might be some truth in what he's saying, I wouldn't take it as gospel just because he's an incredibly wealthy person. The key concerns that he mentioned, you could probably guess, are the Ukraine war, as well as the conflict between Israel and Palestine going on at the moment. These wars can have a very large influence on the world economy and the world's well-being, just because of the politics around the countries involved, but also because of the potential disruption to key supply chains. For example, Ukraine is considered the breadbasket of Europe, and there's a chance that Iran is pulled into the Israeli-Palestinian conflict. Iran is a long-time supporter of Palestine. However, Iran has been responsible for supplying a lot of oil. The US and Iran have been getting on quite well for the past few months. And Iran's oil supply has helped alleviate some of the demand pressures of oil from around the world. This means that there is an incredible balancing act going on at the moment. The US tends to back Israel, Iran tends to back Palestine. The US needs Iran, and if something were to happen, we would see one of the key oil arteries of the world blocked off. And this has been the reason that we've seen a rise in the price of oil recently through the past week. And if this were to escalate even further, I suspect the price of oil would continue running north, setting inflation expectations higher, which would therefore set interest rate hike expectations higher too. All right, so what's going on this week? We're getting the retail sales numbers out of the US tomorrow, so this will tell us how strong the consumer has been through the past month in the US. We'll get the GDP numbers out of China, a key number that tells us the health of the Chinese economy. We'll also be receiving some CPI numbers out of Europe, and one of the most watched numbers will be the initial jobless claims number out of the US on Thursday. In addition to this, it is a big week for earnings, one of the first big weeks for earnings. So tomorrow we will see some large banks reporting in the US. That continues through Wednesday, when we will see the likes of Tesla and Netflix reporting earnings. And on Thursday we will hear from TSM, which is a bellwether for the entire semiconductor industry. All right, that's for this week. I hope you found it useful. I'll speak to you soon. Goodbye.